There is a single deadly sin in the world of money, a sin so tempting, so universally praised, that it has brought down more intelligent people than any other force in financial history. It's whispered in boardrooms as a sign of sophistication. It's taught in business schools as a tool for growth. It's sold to you every single day as the fast lane to the life you want. The sin is leverage, the use of debt, the seductive idea of using other people's money to make yourself rich. And for decades, one man has stood as a bulwark against this tide of financial insanity, building one of the greatest fortunes and most enduring companies in human history, not by embracing this tool, but by treating it as a mortal enemy. That man is Warren Buffett, and his absolute, unshakable aversion to debt is not just a quaint preference, it is the foundational secret to his survival, and therefore, his success. The world will tell you that debt is a tool, Buffett knows it is a weapon, and that sooner or later, it gets pointed directly at your own head. They will tell you that if you're smart, you should use leverage to amplify your returns. Buffett's rule is simpler and infinitely more profound. If you're smart, you don't need it, and if you're dumb, you have no business using it. This is not a lesson about clipping coupons or the virtues of saving a few dollars. This is a deep dive into the core operating system of the world's greatest investor. It is a deconstruction of the single most common reason why empires crumble, why fortunes evaporate, and why brilliant minds end up with nothing. This is the story of the one rule you must follow if you want to stay in the game long enough to win it. Our journey begins not in a moment of triumph, but in a moment of profound restraint, a time when the world was drunk on profit and Warren Buffett alone chose sobriety. This is the first and most crucial pillar of his philosophy. Before you can win, you must first ensure that you can never lose, the prerequisite of survival. To understand this, we must travel back to the late 1960s, a period known as the go-go years. The stock market was a raging party. It was a time of gunslingers and hotshot fund managers who were posting eye-watering returns, 40, 50, even 100% in a single year. The Nifty 50 stocks, companies like Xerox and Polaroid, were seen as one-way bets, stocks you could buy at any price and hold forever. The public was euphoric, convinced that a new era of permanent prosperity had dawned. In this environment, caution was mocked as cowardice. And at the center of this maelstrom was a young Warren Buffett, running his private investment partnership from a small office in Omaha, Nebraska. By all accounts, he was crushing it. His track record was already the stuff of legend. Yet, as he looked at the wild speculation around him, he felt a growing sense of unease. He saw investors paying astronomical prices for companies with flimsy prospects. He saw his peers using massive amounts of leverage, borrowing money to magnify their bets and chase ever higher returns. He saw a disconnect from reality, a speculative bubble that defied the laws of financial gravity. In May of 1969, Buffett did something almost unthinkable. He sat down and wrote a letter to his partners, the friends and family who had entrusted him with their life savings. It was not a letter celebrating their incredible gains. It was a letter of abdication. He announced he was closing the Buffett partnership, he was liquidating the fund and returning their capital. Imagine the reaction. Here was the most successful investor of his generation, at the peak of his powers, walking away from the table while the game was at its hottest. He was voluntarily shutting down the very vehicle that had made him a millionaire. His partners were confused, some were even angry. They implored him to stay, to keep the money machine running. Why quit now? The answer lay in a simple, profound commitment to survival. In his letter, he wrote, "I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand just so I can stay in the lineup." He explained that to compete in that kind of speculative frenzy, he would have to betray his own principles. He would have to buy things he didn't understand at prices that made no sense. He might even have to use leverage to keep up with the gunslingers, and that was a risk he was completely unwilling to take. He wasn't just giving up potential future gains. He was actively protecting his partners and himself from a catastrophic loss that he felt was inevitable. He chose survival over the siren song of more. He chose to guarantee he could play another day, even if it meant sitting out the rest of the party. And what happened next? The party came to a crashing halt. The bear market of 1973-1974 arrived with a vengeance. The stock market collapsed by nearly 50%. Those nifty 50 stocks, the one-way bets, were decimated. Xerox fell by over 70%. Polaroid, the Apple of its day, fell by over 90%. The gunslinging fund managers who had been celebrated as geniuses were wiped out, their leveraged portfolios evaporating into thin air. They had been playing a game of musical chairs, and when the music stopped, their use of debt meant they had no chair to sit on. They were ruined. And where was Warren Buffett? He was on the sidelines, his capital intact, his mind clear. He hadn't lost a dime of his partners' original capital in the crash because he had already returned it to them. He had prioritized their financial protection over his own ego. This singular act of selling at the top, not out of a perfect prediction but out of a deep-seated philosophy of risk management, cemented his reputation. He didn't just make money. He understood that the first rule of money management is not losing it. This anecdote is the bedrock of his entire philosophy on debt. Leverage is the enemy of survival because it takes the decision out of your hands. A leveraged investor is a fragile investor. A market downturn that would be a temporary paper loss for an unleveraged investor becomes a fatal event for someone with debt, triggering a margin call and forcing them to sell at the absolute bottom. Buffett's decision in 1969 was a declaration of independence from this servitude. He would not allow market madness to dictate his actions. He would not play a game where the downside was total ruin. He chose to survive. The psychological principle at play here is one of the most powerful forces in human decision-making. The battle between our primal survival instinct and the more modern, socially driven affliction of FOMO, the fear of missing out. Our brains are hardwired for survival. For millennia, the primary objective was to avoid saber-toothed tigers and find enough food to live another day. This instinct manifests in finance as a healthy fear of losing everything, of going to zero. However, in our modern, hyper-connected world, a new and powerful instinct has emerged, the fear of being left behind. We see stories of people getting rich quick in crypto, in tech stocks, in real estate, and a powerful social pressure builds. This is FOMO, and it is the mortal enemy of sound financial planning. Debt is the accelerant that pours gasoline on the fire of FOMO. It tells you that you don't have to wait, you don't have to save, you can have it all now, tachuayu. It allows you to participate in the speculative mania even if you don't have the capital. It hijacks your rational brain by promising to close the gap between you and the people you see succeeding. What Buffett understands, on a level deeper than almost anyone, is the concept of ergodicity. It's a fancy word for a simple idea. To achieve success over the long run, you must first and foremost survive the short run. You cannot compound wealth if your capital goes to zero. There is no recovery from ruin. A single event of total loss takes you out of the game forever. Most people think about investing in terms of averages. The market returns 10% a year on average. But reality is not an average. It is a single path through time, and that path can include events that are fatal. Leverage turns survivable downturns into these fatal, non-ergodic events. It introduces a point of no return. Buffett's decision to close his partnership was an act of supreme emotional discipline. He suppressed the FOMO of the go-go years and listened instead to his primal survival instinct. He recognized that the environment had become non-ergodic, that the risk of ruin, however small it seemed to others, had become unacceptably high. He chose to break the system rather than let the system break him. This is a core lesson in wealth protection. You must structure your financial life in a way that you can never be forced out of the game. So how do we translate this into a practical, applied mental model? We can call it the game over audit. This is a blueprint for systematically identifying and eliminating the risk of ruin from your financial life, a cornerstone of personal finance advice. Step 1. Full spectrum leverage identification. You must take a brutally honest inventory of every form of debt and leverage in your life. This isn't just a business loan. It's your mortgage, your home equity line of credit, your car loans, your student loans, your credit card balances, any margin loans in your brokerage account, even buy now, pay later plans. List every single one and the amount owed. You cannot manage a risk you have not measured. Step 2. The stress test simulation. For each item on your list, you must run a worst-case scenario simulation. Do not be gentle. What happens if your household income is cut in half for 6 months? What happens if the interest rate on your variable rate debt doubles? What happens if the value of the asset securing the loan, like your house or your stock portfolio, drops by 40%? The key question is, does this scenario trigger a cascade of failure? Would you be forced to sell assets at a loss just to make payments? Would you default? This isn't about predicting the future. It's about understanding your fragility. Step 3. Calculate your survival runway. Based on your current cash reserves and burn rate, how many months could you survive if your primary source of income disappeared tomorrow? This is your ultimate measure of financial stability. A runway of less than 6 months indicates a high degree of fragility. A runway of over 2 years indicates a robust, anti-fragile position. Step 4. The deleveraging protocol. Your final goal is to systematically eliminate any scenario that leads to game over. This means creating a concrete plan for how to get out of debt, prioritizing the highest interest and most dangerous forms of leverage first, like credit card and margin debt. It may mean downsizing your lifestyle, selling an over-leveraged asset, or building a much larger cash cushion. The objective of the Game Over audit is to re-engineer your financial life from one that is optimized for returns to one that is optimized for survival. Only from a position of absolute security can you begin to think about building lasting wealth. This is the foundation of financial freedom. Now let's look at the antithesis, the path of the 99%. This is the approach taken by the vast majority of people, often with the best of intentions, that leads to financial distress. The 99% see debt not as a threat, but as a necessary tool, a ladder to climb. They embrace the idea of good debt, a dangerously misleading concept. Consider the common narrative around real estate. In 2006, at the peak of the housing bubble, millions of ordinary Americans believed they were investment geniuses. They would buy a home with 3% down, sometimes even 0% down, using extreme leverage. The logic seemed flawless. Real estate only goes up. They weren't just buying a place to live. They were making a leveraged bet on the housing market. They would then take out a home equity line of credit, AHELOC, to buy a boat, renovate the kitchen, or even use it as a down payment on a second investment property. They were pyramiding leverage upon leverage. Their friends were doing it. The financial news celebrated it. It was the American dream on steroids. This behavior is a perfect illustration of ignoring the principle of survival. These individuals were completely exposed. Their financial stability was predicated on a single variable, the continued rise of housing prices. They had no margin of safety. When the music stopped in 2008, the consequences were devastating. Housing prices cratered. Suddenly, they were underwater, owing more on their mortgage than their house was worth. Many had adjustable-rate mortgages, and as their rates reset, their payments skyrocketed. Then came the layoffs. Faced with a job loss and an impossible mortgage payment, they had no choice. They were forced to sell into a collapsing market, locking in massive, life-altering losses. They were foreclosed upon, their credit was destroyed, and their life savings were wiped out. They experienced a personal game-over event. The dream of building wealth through leverage had become a nightmare of financial ruin. This wasn't because they were bad people. It was because they followed the conventional wisdom, which is almost always optimized for the lender, not the borrower. They played a game they didn't understand, and they paid the ultimate price. The direct financial connection between Buffett's anti-debt philosophy and tangible wealth is most clearly seen when you compare the balance sheets of two companies entering a recession. This is where the principle of survival translates into a massive competitive advantage and an engine for building wealth. Let's imagine two businesses, Company A and Company B, both in the same industry, both equally profitable in the good times. Company A, following the path of the 99%, has used debt aggressively to finance its growth. Its balance sheet is loaded with loans. It has high quarterly interest payments that must be made, rain or shine. This is a key aspect of corporate finance. Company B, following the Buffett model, has grown more slowly, financing its expansion through its own retained earnings. Its balance sheet is a fortress, with very little debt and a large pile of cash. Now, a deep recession hits. Revenue for both companies plummets by 30%. For Company A, this is a catastrophe. Their profits evaporate, but their large interest payments to the bank remain. They are now losing money every single month. They breach their debt covenants, the rules set by the lender. The bank gets nervous and starts restricting their credit. The CEO is forced into short-term survival mode. They have to lay off their best engineers, slash their research and development budget, and sell off a promising division at a fire sale price just to raise cash to service their debt. Their focus shifts from innovation and customer service to simply appeasing their creditors. For Company B, the recession is a challenge, but not an existential threat. With no significant interest payments, the drop in revenue is painful but manageable. They can afford to keep their key employees. They can continue to invest in R&D. But here is the crucial part. Company B now goes on the offense. The CEO sees that Company A is being forced to sell its best assets at pennies on the dollar. Company B uses its mountain of cash to buy that promising division from Company A for a fraction of its true worth. They can hire the talented engineers that Company A just laid off. In a single move, Company B has not only survived the storm, but has used it to permanently strengthen its competitive position. The recession that cripples the leveraged company becomes the opportunity of a lifetime for the unleveraged one. This is exactly what Berkshire Hathaway does. Its avoidance of debt isn't just a defensive posture, it's the foundation of its predatory offensive strategy. It allows Buffett to be greedy when others are fearful, because he has the one thing that disappears in a crisis: cash. This is how a fortress balance sheet, a direct result of avoiding debt, translates into a staggering and tangible financial advantage. The second pillar of Buffett's philosophy on debt goes beyond mere survival and delves into the brutal mathematics of risk. It's the recognition of leverage's lethal asymmetry: heads I win, tails I lose everything. This principle exposes the fundamental fallacy that leverage is a symmetrical tool that just magnifies returns. The reality is far more sinister. It magnifies gains to a limited degree, but it magnifies losses to the point of total annihilation. There is no story that illustrates this lethal asymmetry better than the spectacular collapse of long-term capital management, or LTCM. If ever there was a group of people who should have been able to handle the risks of leverage, this was it. The firm, founded in 1994, was a hedge fund of unparalleled intellectual firepower. Its boardroom included John Meriwether, the legendary head of bond trading from Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, the creators of the Black-Scholes model for pricing options, a cornerstone of modern financial theory. These were not just smart guys, they were the high priests of financial risk management. Their strategy was complex, involving arbitrage trades, where they would exploit tiny, almost imperceptible pricing discrepancies between related securities around the world. Because the profits on each individual trade were minuscule, they needed to deploy an immense amount of capital to generate meaningful returns. And to do that, they used leverage on a scale that was, at the time, unimaginable. For every $1 of their own capital, they borrowed over $25. But that was just the on-balance sheet leverage. The derivatives positions they held meant their true economic leverage was closer to 100 to 1, or even higher. For 4 years, it worked like a charm. They were the kings of Wall Street, generating returns of over 40% annually with seemingly no volatility. They believed their Nobel Prize-winning models had tamed risk, that they had created a money-printing machine that could not fail. Their hubris was a direct result of their intellect. They believed they were smarter than the market. They believed their models, which were based on historical data, could predict all future possibilities. But in August 1998, the future did something it wasn't supposed to. Russia, a country they deemed too insignificant to derail their global strategy, defaulted on its government debt. It was a black swan event, a Six Sigma deviation that their models said was statistically impossible, something that shouldn't happen in the entire lifespan of the universe. Yet, it happened. The effect was instantaneous and global. A flight to safety and liquidity swept through the financial markets. Investors dumped risky assets and fled to the security of U.S. Treasury bonds. The tiny price discrepancies that LTCM exploited for profit didn't converge as their models predicted. They blew out to unprecedented levels. Suddenly, their risk-free arbitrage trades were generating catastrophic losses. And here, the lethal asymmetry of leverage revealed its fangs. An unleveraged investor facing these losses would have been hurt, but they would have survived. For LTCM, with its 100 to 1 leverage, every 1% move against them meant a 100% loss. Their equity was wiped out in a matter of weeks. The titans of finance, the Nobel laureates, were bankrupt. The situation was so dire that the Federal Reserve had to intervene, orchestrating a massive $3.6 billion bailout from a consortium of Wall Street banks to prevent the collapse of LTCM from triggering a global financial meltdown. Warren Buffett was even called in as a potential participant in the rescue. He famously made a lowball offer to buy out the entire portfolio, an offer that was ultimately rejected but highlighted the absurdity of the situation. The smartest men in the room had created a risk so large that only the most conservative man in the room could even contemplate cleaning it up. The story of LTCM is Buffett's anti-leverage thesis made manifest. It proves that intelligence is no defense against the brutality of leverage. In fact, it can be a disadvantage, creating an overconfidence that leads you to take risks you don't fully understand. It shows that leverage doesn't just magnify returns. It creates an entirely new kind of risk, the risk of ruin, which is not present in an unleveraged world. The upside was making more money. The downside was vaporizing their firm and nearly taking the global economy with it. That is a trade no rational person should ever take. The underlying psychological principle at work here is a deadly combination of overconfidence bias and what the writer Nassim Nicholas Taleb calls black swan blindness. Overconfidence bias is the tendency for people to believe they are smarter and more skilled than they actually are. The partners at LTCM were not just confident, they were infected with a level of intellectual hubris that bordered on a secular faith. They genuinely believed their mathematical models had unlocked the secrets of the universe. This is a common trap for intelligent people, particularly in fields that involve complex analysis. They fall in love with their own models and forget that the map is not the territory. The real world is infinitely more messy, complex, and unpredictable than any set of equations can capture. Leverage is the great amplifier of this bias. Without leverage, if you are overconfident and make a mistake, you lose some money, learn a painful lesson, and move on. With leverage, that same mistake, born of the same overconfidence, can be fatal. It removes all room for error. Black swan blindness is the inability to account for rare, high-impact events that lie outside the realm of regular expectations. The LTCM models were built on a bell curve of historical data. They were prepared for events that were 1, 2, or 3 standard deviations from the norm. They were completely unprepared for a Six Sigma event like the Russian default, because, according to their data, it was impossible. Buffett's entire approach to capital management is designed to protect against this blindness. He famously says he wants to be able to withstand any event, no matter how improbable. He runs Berkshire Hathaway, assuming the stock market could be closed for years, that credit markets could freeze, that their insurance division could face a $100 billion hurricane. He is obsessed with surviving the black swan. Leverage does the opposite. It makes you exquisitely vulnerable to the black swan. It builds a system that is optimized for efficiency in normal times, but that is so fragile it will shatter at the first encounter with the unexpected. The partners at LTCM thought they were geniuses for picking up pennies in front of a steamroller. They were, until the steamroller, the black swan they thought couldn't exist, finally arrived. To counter this dangerous psychology, we can develop an applied mental model called the leverage barbell. This provides a more nuanced framework for risk management, acknowledging that not all leverage is created equal, and allowing for intelligent risk-taking in a controlled environment. The core thesis of this video is an aversion to the asterisk indiscriminate names use of debt, not necessarily the complete elimination of all forms of risk. A barbell strategy, popularized by Nassim Taleb, involves concentrating your resources at two extremes rather than in the middle. Step 1. Build the fortress. The vast majority of your capital, say 90% to 95%, should be placed in the ultra-safe, unleveraged side of the barbell. This is your fortress. This includes assets like cash, short-term treasury bills, and a diversified portfolio of high-quality stocks bought without any margin debt. This portion of your portfolio is designed for one thing: survival. It is robust to black swans. It cannot be wiped out by a market crash. This is your stay-in-the-game capital. Step 2. Isolate speculative bets. The remaining 5% to 10% of your capital is placed on the other end of the barbell, the high-risk, high-reward side. This is where you can make speculative bets. This might include buying call options, investing in a friend's startup, or speculating in a volatile asset class. The key is that these investments have an asymmetric payoff profile. Your downside is strictly limited to the small amount of capital you invest, but your upside could be 10, 20, or even 100 times your investment. This is a form of controlled, intelligent leverage. For example, buying a call option gives you control over a large number of shares for a small premium. If you are wrong, you only lose the premium. If you are right, the gains can be enormous. Step 3. Maintain absolute separation. The critical rule of the leverage barbell is that the two sides must never touch. You never use leverage on the safe side of your portfolio. You never take out a margin loan against your core stock holdings to fund a speculative bet. You never risk the 95% for the sake of the 5%. This discipline is what separates intelligent risk management from reckless gambling. The barbell model allows you to participate in potential windfalls without ever exposing yourself to the risk of ruin. It's a structure for financial stability that still leaves room for the explosive growth that can come from entrepreneurship and smart speculation. The antithesis to this disciplined model is the path taken by the 99% in today's market, which can be best described as the lottery ticket mentality. This is particularly prevalent among a new generation of retail investors who have been conditioned by commission-free trading apps and the gamified nature of modern finance. Their strategy isn't a barbell. It's a fragile single point of failure system. They see a stock being hyped on a social media forum and go all in, not just with their savings, but with borrowed money. They take out margin loans, a direct and dangerous form of leverage, to buy more shares. They trade complex options contracts with little understanding of the underlying mathematics, mesmerized by the triple-digit percentage gains they see posted by anonymous accounts online. They treat the stock market not as a mechanism for capital allocation in productive enterprises, but as a global casino. This approach is the embodiment of lethal asymmetry. They are exposing 100% of their capital to the risk of a 100% loss. They see only the upside, the dream of turning a few $1,000s into a life-changing fortune overnight. They are psychologically blind to the downside, because the culture they are immersed in dismisses catastrophic losses with memes and jokes about diamond hands and loss porn. But when the loss is real, when their life savings are gone, it is no longer a joke. The psychological damage can be as devastating as the financial loss. This behavior is fueled by a system that profits from their activity. The more they trade, the more they use margin, the more money their brokers make. It is a perfect storm of overconfidence bias, FOMO, and a financial ecosystem designed to encourage the worst possible impulses. They are not building wealth. They are engaging in a high-stakes gamble where the odds are structurally stacked against them, and where the consequence of being wrong is not just a setback, but total financial obliteration. The direct financial connection of this lethal asymmetry is brutally simple and can be explained with elementary school math. This is the math that the geniuses at LTCM tragically forgot. Let's say you have $100,000 and you invest it in the stock market. The market drops by 50%. This is a severe, painful bear market. Your portfolio is now worth $50,000. It's a terrible outcome, but you are still in the game. You have lost half your money, but you still have capital. For your portfolio to get back to the original $100,000, it now needs to achieve a 100% gain from its new, lower base of $50,000. It's a difficult climb, but it is mathematically possible. You have survived to fight another day. Now, let's introduce leverage. You take your $100,000 and you borrow another $100,000 from your broker on margin, giving you $200,000 to invest. You are at 2-to-1 leverage. The same 50% market drop occurs. The value of your total investment of $200,000 is cut in half to $100,000. But remember, $100,000 of that was borrowed money that you still owe to your broker. So you are left with your current portfolio value of $100,000 minus the $100,000 you owe the broker. Your net worth is now precisely zero. You have been completely wiped out. There is no coming back. There is no 100% gain that can save you, because you have no capital left to grow. You are out of the game forever. This is the point of no return. The math becomes even more terrifying at higher levels of leverage. At 4-to-1 leverage, a 25% drop wipes you out. At 10-to-1 leverage, a mere 10% drop against you is a fatal event. This is the simple, unforgiving arithmetic that governs risk. Leverage transforms the return distribution. Without leverage, your potential outcomes are spread across a wide range, from large gains to large but survivable losses. With leverage, the distribution becomes horribly skewed. The possibility of total ruin goes from being a zero probability to a non-zero, and often frighteningly high, probability. This single mathematical fact is why Buffett shuns leverage. It's not a matter of opinion or style. It is an objective, quantifiable reality of capital management. This brings us to the third pillar, a concept that moves beyond defense and into the realm of strategic dominance. It is the unfair advantage of staying power. By avoiding debt, Buffett doesn't just survive storms. He harnesses their power. His fortress balance sheet, built on a mountain of cash and unleveraged assets, gives him the ability to outlast any crisis and, more importantly, to act decisively when everyone else is paralyzed by fear and forced to sell. Staying power is the ability to manufacture your own luck. The most powerful illustration of this principle in action took place during the darkest days of the 2008 global financial crisis. The entire global financial system was on the brink of collapse. Lehman Brothers had filed for bankruptcy, triggering a panic that froze credit markets around the world. Confidence evaporated. Institutions that had stood for a century were either failing or being bailed out by the government. The stock market was in freefall. Fear was palpable. In this environment of absolute terror, nearly every major financial institution was desperate for one thing: cash. Their balance sheets were loaded with toxic assets, and their access to borrowing had been cut off. They needed capital to survive, and they needed it immediately. And in this desert of liquidity, there was one giant oasis: Berkshire Hathaway in Omaha, Nebraska. On September 23, 2008, as the crisis reached its zenith, Goldman Sachs, the most prestigious investment bank in the world, was fighting for its life. Its stock price was plummeting. Investors feared it would be the next Lehman. That afternoon, the phone rang in Warren Buffett's office. It was the CEO of Goldman Sachs. He needed capital, and he needed the Buffett stamp of approval to restore confidence in his firm. A few weeks later, a similar call came from Bank of America, another titan on the ropes. In both cases, Buffett had all the leverage. He was the only person with the capital and the credibility to act as a lender of last resort. And because of this unique position, he was able to demand terms that were almost outrageously favorable. For his $5 billion investment in Goldman Sachs, he received preferred stock that paid him a 10% annual dividend. That's $500 million a year, guaranteed, like clockwork. On top of that, he received warrants that gave him the right to buy $5 billion worth of common stock at a fixed price for the next 5 years. This was an incredibly sweet deal. He was being paid handsomely to wait, and if the company recovered, his warrants would be worth billions. He struck a similar deal with Bank of America. These were not investments he could have made in normal times. They were once-in-a-generation opportunities created by the panic and desperation of others. And why was Buffett the only one who could make these deals? Because of his lifelong aversion to debt. Berkshire Hathaway had tens of billions of dollars in cash on its balance sheet. It had no debt to service, no nervous bankers to answer to. While other firms were forced sellers, desperately trying to raise cash to cover their own leveraged bets, Berkshire was a ready and waiting buyer. He had the staying power. He could patiently wait for years for the perfect pitch, and when it came, he could swing with the full force of his capital. This is the ultimate offensive weapon in investing. Staying power, born from a debt-free balance sheet, allows you to transform the market's greatest moments of fear into your own greatest moments of opportunity. The psychological principle that allows this unfair advantage to exist is the interplay between loss aversion and herd behavior. Loss aversion is a well-documented cognitive bias, where the pain of losing is psychologically about twice as powerful as the pleasure of gaining. A $1,000 loss hurts more than a $1,000 gain feels good. During a market crash, this instinct goes into overdrive. Investors are not just seeing numbers on a screen go down. They are feeling intense, visceral pain. Their primary impulse is to make the pain stop, which usually means selling, often at the point of maximum pessimism. This individual pain is then amplified by herd behavior. When we are uncertain and afraid, we look to others for cues on how to act. In a financial panic, the herd is stampeding for the exits. Seeing everyone else selling creates immense social pressure to do the same, even if it contradicts a rational long-term investment strategy. It's the fear of being the last one out, the idiot holding on while everyone else saves themselves. Buffett's fortress balance sheet acts as a powerful psychological shield against these two forces. Because he has no debt, he faces no external pressure. No margin call can force him to sell. No loan covenant can be breached. This external stability creates internal calm. It allows his rational brain, what he calls his inner scorecard, to remain in control while the rest of the world is succumbing to its most primitive fears. He is insulated from the panic of the herd. This freedom from pressure allows him to invert the emotional response. While others feel the intense pain of loss aversion, he sees the opportunity created by their selling. He is able to be, in his famous words, greedy when others are fearful. His lack of debt is not just a financial state, it is a psychological state. It is the bedrock of the emotional fortitude required for superior investment decision-making. He doesn't have to predict when the panic will end. He just has to be financially and psychologically prepared to act when it arrives. This leads to a powerful applied mental model for the individual investor, the creation of a dedicated crisis capital fund. This is a practical blueprint for operationalizing Buffett's strategy on a personal scale, a key component of sophisticated financial planning. This is not your standard emergency fund, which is designed to cover living expenses in case of a job loss. This is an offensive weapon. Step 1. Formalize the fund. You must create a separate, designated account for your crisis capital. It cannot be commingled with your emergency fund or your long-term retirement savings. Giving it a name and a separate existence creates a powerful psychological barrier against tapping it for other purposes. This is your "be greedy when others are fearful" account. Step 2. Define the deployment trigger. You must decide in advance and in a moment of calm exactly what conditions will allow you to deploy this capital. This removes emotion from the decision-making process. A good trigger could be a specific significant drop in a major market index, for example. I will begin to deploy my crisis capital when the S&P 500 is down 30% from its all-time high. Write this rule down. It is your constitution. Step 3. Automate the accumulation. Set up an automatic recurring transfer into your crisis capital fund. It doesn't have to be a huge amount, but it must be consistent. The goal is to slowly and patiently build this pool of capital during the good times, when you least feel you need it. This fund should be held in safe, liquid assets, like cash or short-term treasury bills. It is not meant to generate high returns. It is meant to provide dry powder. Step 4. Create your shopping list. Also in advance, you should create a list of the high-quality assets you would love to own if their prices were significantly lower. This could be a list of 5 to 10 specific blue-chip stocks, a broad market index fund, or even a specific piece of real estate. When your trigger is hit, you don't have to think. You simply execute your predetermined plan. By creating a crisis capital fund, you fundamentally change your psychological relationship with market volatility. A 30% market crash is no longer a source of terror. It is the signal you have been patiently waiting for. It transforms you from a victim of the market into a predator. This is a crucial step towards achieving true financial freedom. The antithesis of this prepared, strategic approach is, once again, the path of the 99%. This is the investor who is fully invested and often leveraged at the peak of the market cycle. Their psychology is driven entirely by FOMO. They see the market going up, and they are terrified of being left behind. So they put every last dollar they have into the market. They might even take out a home equity loan or a margin loan to buy more, believing they are geniuses for riding the bull market. They have no cash reserves, no dry powder. Their financial position is brittle, optimized for a single outcome: the market continuing to go up. When the inevitable correction or crash arrives, they are completely exposed. Not only are they unable to buy the dip, but they are often forced to do the exact opposite. The market crash might coincide with them losing their job. Now, to pay their mortgage and put food on the table, they have to sell their stocks, liquidating their portfolio at the worst possible moment. If they have used margin, their broker will issue a margin call, forcing them to sell to cover their loan, again at the absolute bottom. They are compelled to sell low because they bought high. They lock in permanent, devastating capital losses. This is the tragic cycle that traps most investors. They are psychologically and financially positioned to do the exact wrong thing at the exact wrong time. They buy in euphoria and sell in panic. They have no staying power. Their lack of a fortress balance sheet means they are puppets, their strings pulled by the whims of the market and the demands of their creditors. They are destined to be the source of opportunity for the prepared investor, the very people from whom Buffett and his followers will buy their assets for pennies on the dollar. The direct financial connection between staying power and wealth generation is perfectly quantified in the details of Buffett's 2008 Goldman Sachs investment. Let's break down the staggering profitability of being the only person who could write a check. First, the preferred stock. Buffett invested $5 billion. In return, he received a 10% dividend, which meant Goldman Sachs paid Berkshire Hathaway $500 million in cash every single year. By 2011, when Goldman redeemed the preferred stock, Berkshire had collected over $1.5 billion in dividends alone. Goldman also had to pay a 10% premium to buy it back, giving Buffett an extra $500 million. So on the safe part of his investment, he made a guaranteed $2 billion. But the real prize was the warrants. The warrants gave Buffett the right to buy 43.5 million shares of Goldman Sachs common stock for $115 per share, any time over the next 5 years. As the markets recovered and Goldman's stock price soared, these warrants became immensely valuable. In 2013, instead of spending billions to exercise the warrants, Buffett renegotiated the deal. He traded the warrants for a smaller number of actual shares, worth roughly $2 billion at the time. All told, on his initial $5 billion investment, Buffett's Berkshire Hathaway walked away with a profit of more than $4 billion in less than 5 years. This wasn't a lucky stock pick. This was a profit generated directly from the weakness of others and his own firm's immense financial strength. The alpha, the excess return, was not derived from a secret valuation model, it was derived from his balance sheet. This is the ultimate proof of the concept. A decades-long commitment to avoiding debt, a policy that may have seemed overly conservative and cost him returns during bull markets, directly enabled him to execute a trade that generated billions of dollars in profit. This is how money management, specifically capital management focused on financial stability, translates into an almost insurmountable competitive advantage. Staying power isn't passive, it's a loaded weapon. This leads us to the fourth pillar, a more subtle but equally destructive aspect of debt, the chains of servitude. When you take on debt, you are not just borrowing money, you are sacrificing your sovereignty. You are willingly placing a master over your decisions. Leverage corrupts incentives, forces short-term thinking, and ultimately transfers control from you to your creditor. It makes you a servant to the numbers on a balance sheet rather than the master of your own destiny. A powerful historical anecdote that perfectly illustrates this loss of sovereignty is the story of the Hunt brothers and their attempt to corner the world silver market in the late 1970s. Nelson Bunker Hunt and William Herbert Hunt, sons of a Texas oil tycoon, believed that global inflation would cause the value of paper currencies to collapse, and that precious metals, particularly silver, were the ultimate store of value. They began accumulating enormous physical quantities of the metal, but they didn't stop there. To supercharge their bet, they used immense leverage, taking out massive loans to buy silver futures contracts. For a while, their thesis played out spectacularly. The price of silver skyrocketed from around $6 an ounce in early 1979 to nearly $50 an ounce in January 1980. The Hunt brothers were on top of the world, their fortunes swelling to billions of dollars. They were hailed as visionaries. However, their leveraged position made them extremely vulnerable. In response to their market manipulation, the commodity exchanges and the Federal Reserve changed the rules of the game. They imposed trading restrictions and increased margin requirements, making it much more expensive to hold leveraged positions. This, combined with the soaring prices, caused demand for silver to collapse. The price began to fall, slowly at first, and then with terrifying speed. This is where the chains of servitude tightened. For an unleveraged investor, a drop in the price of silver would have been a paper loss, but the Hunt brothers were massively leveraged. As the price fell, their lenders and brokers issued margin calls, demanding billions of dollars in additional collateral to cover their potential losses. The Hunts no longer had control over their own investment thesis. Their decisions were not being driven by their long-term view on inflation or the value of silver. They were being dictated, hour by hour, by the frantic demands of their creditors. They were forced to sell. But their position was so large that their own selling accelerated the price collapse, triggering even more margin calls in a vicious death spiral. The climax came on March 27, 1980, a day that became known as Silver Thursday. The price of silver cratered by more than 50% in a single day. The Hunt brothers were unable to meet a $100 million margin call, and the entire structure came crashing down. They were wiped out. Their billion-dollar fortune was gone. They were forced into bankruptcy, hounded by lawsuits and regulatory investigations for years. The key lesson from their downfall is not that their thesis on silver was right or wrong. The lesson is that their use of leverage meant they never got to find out. They lost their agency. Their creditors became the ultimate decision makers, and the creditors' only goal was self-preservation, not the success of the hunt's investment. Debt had transformed them from bold market speculators into helpless subjects, forced to liquidate their life's work at the worst possible time. They lost not just their money but their freedom. The underlying psychological and economic principle here is known as agency theory, which is amplified by a psychological phenomenon called reactance. Agency theory is a concept from corporate finance and economics that describes the inherent conflict of interest between a quote, in this case you, the borrower, and an agent who makes decisions on their behalf, in this case your lender. Your goal as the borrower is to maximize your return on investment. The lender's goal is fundamentally different. Their goal is simply to get their money back with interest. They have limited upside, the interest they charge you, but 100% downside if you default. Because of this skewed incentive structure, the lender will always prioritize risk mitigation and self-preservation over your potential for profit. When you take on debt, you are creating a powerful new stakeholder in your life or business whose interests are not aligned with your own. This conflict is manageable in good times, but it becomes a battle for control during times of stress. When things go wrong, the agent, the lender, will exercise their power to protect themselves, even if it means destroying you, the principal. Reactance is the strong emotional response people have when they feel their freedom is being threatened or eliminated. It's that feeling of being trapped, of being told what to do. The stress of dealing with margin calls and angry lenders impairs rational decision-making. You're no longer thinking about the long-term fundamentals of your business or investment. You're in a short-term panic, reacting to the demands of the party that now controls your fate. Buffett's aversion to debt is, at its core, an aversion to this loss of agency. He has structured his entire life, and the entirety of Berkshire Hathaway, to have as few external dependencies as possible. He answers to no one but his shareholders, and because he controls a huge portion of the shares, he effectively answers only to himself and his partner Charlie Munger. This is the ultimate form of financial and intellectual freedom, a sovereignty that allows for truly long-term, rational decision-making, free from the corrupting influence of a lender's conflicting agenda. To put this principle into practice, we can create a mental model called the Sovereignty Scorecard. This is a tool for auditing your life and finances to determine how much control you truly have. And it's a critical exercise in financial planning. Step 1. Enumerate your obligations. Just as in the game over audit, start by listing every single debt you have: mortgage, car loan, business loans, student loans, credit cards. Step 2. Identify the covenants and conditions. Next to each debt, write down the specific rules and conditions that come with it. What is the collateral? What events could trigger a default? What are the penalties for a late payment? For a business loan, are there financial ratios you must maintain? For a mortgage, what is the loan-to-value ratio? You need to understand the exact mechanisms by which control can be taken away from you. Step 3. Ask the control question. For each obligation, ask yourself this brutally honest question. In a crisis, who is in control of this asset or this part of my life, me or the lender? If you lost your job, does the bank control your house? If your business has a bad quarter, does your lender have the right to seize your inventory? Be ruthless in your assessment. Step 4. Assign a sovereignty score. For each debt, assign a score from 1 to 10, where 1 means the lender has total control and you have none, and 10 means you have complete and total control. A credit card with a high balance might be a 2. A small, manageable mortgage on a house with lots of equity might be a 7. Your final goal is to develop a systematic plan to increase your average sovereignty score over time. This means paying down debt, especially the most restrictive and dangerous kinds. The goal isn't just to be debt-free for its own sake. The goal is to reclaim your financial sovereignty, to become the sole master of your own decisions. This scorecard transforms the abstract idea of getting out of debt into a tangible quest for freedom. The antithesis of this quest for sovereignty is the path of the modern entrepreneur, especially in the tech world. The prevailing wisdom in Silicon Valley is to raise as much money as possible, as quickly as possible, from venture capitalists. On the surface, this seems like smart business finance. It's using other people's money to grow fast. But what many founders fail to realize is that they are not just taking on capital, they are taking on a new set of masters. Venture capital is not alone, but it functions in a similar way, creating a powerful stakeholder with its own agenda. The VC's goal is not necessarily for the business to become a stable, profitable, long-term enterprise. Their goal is to achieve a 10x or 100x return on their investment within a 5 to 7 year fund lifecycle. This creates immense pressure on the founder to pursue growth at all costs, a strategy often called blitz scaling. The founder is forced to hire aggressively, spend lavishly on marketing, and expand into new markets, often before the core business is even profitable. They give up board seats, ceding control over the strategic direction of the very company they created. If they fail to meet the hypergrowth expectations of their investors, they can be diluted in future funding rounds, or even replaced as CEO. They become an employee in their own company, executing the vision of their investors rather than their own. This is a Faustian bargain. They trade sovereignty for speed. They might achieve a massive valuation on paper, but they have lost the freedom to build the company they truly want on their own terms. This is the modern version of the Hunt brothers' trap. Taking on outside capital seems like a smart way to accelerate a vision, but it often ends with the vision being co-opted and controlled by the providers of that capital. The direct financial connection of this loss of sovereignty can be found buried in the legal documents that govern debt, specifically in a section called debt covenants. This is where the chains of servitude are formally written into law. Covenants are rules and restrictions that a borrower must abide by to avoid defaulting on their loan. They are the lender's way of maintaining control and managing their credit risk. There are positive covenants, which are things a company must do, such as maintain a certain level of insurance or provide audited financial statements. And there are negative covenants, which are things a company cannot do without the lender's permission. These are far more restrictive. A negative covenant might forbid a company from selling major assets, from taking on additional debt from another lender, or from paying out dividends to its shareholders. The most critical covenants are usually financial, such as the requirement to maintain a certain debt-to-equity ratio or a minimum level of working capital. If a company's performance slips during a recession and it breaches one of these financial covenants, it is in technical default. At that point, the lender has the legal right to demand immediate repayment of the entire loan. This is the ultimate trump card. The lender can effectively seize control of the company, force it into bankruptcy, or dictate the terms of its survival. For anyone involved in business finance or entrepreneurship, understanding debt covenants is not optional. It is the literal text that describes how and when you will lose control of your own enterprise. Buffett's decision to build Berkshire with almost no debt at the parent company level is a strategic decision to never be bound by these chains. It ensures that his decision-making is driven by business logic and long-term value creation, not by the need to satisfy a clause on page 74 of a loan agreement. This brings us to the fifth and final pillar. If Buffett so vehemently rejects the conventional tool of leverage, what does he use in its place? This is where we uncover his masterstroke, the engine that has powered Berkshire Hathaway for over half a century. This is the master's alternative, the genius of insurance float. To truly grasp Buffett's brilliance, you must understand that he found a way to consistently use other people's money, often for free or even at a negative cost, without any of the risks or loss of sovereignty associated with traditional debt. The story of this discovery begins in 1967. At this point, Berkshire Hathaway was still primarily a struggling textile business, a relic of a dying New England industry. Buffett knew he needed a new source of capital to redeploy into better businesses. That year, he orchestrated the acquisition of two small insurance companies in Omaha, National Indemnity Company and National Fire and Marine Insurance Company. On the surface, it looked like a strange move, but Buffett didn't see an insurance company. He saw a money machine. He had discovered the magic of float. Float is a concept unique to the insurance industry. Insurance companies collect premiums from their customers up front, today. However, they don't pay out claims until much later, sometimes years or even decades in the future. This pool of money, the premiums they have collected but have not yet paid out in claims, is the float. It doesn't belong to the insurance company. It is technically a liability on their balance sheet because it will eventually be paid out to policyholders. But in the interim between collecting the premium and paying the claim, the insurance company gets to invest that float for its own benefit. This was the light bulb moment for Buffett. He realized that float was a form of leverage. It was other people's money, but it was infinitely better than debt. A bank loan comes with three major drawbacks. It has a fixed due date, it requires regular interest payments, and it comes with restrictive covenants. Insurance float has none of these. There is no due date. As long as the company keeps writing new policies, the pool of float is constantly replenished. There are no interest payments. In fact, if the insurance operations are run well, they can generate an underwriting profit, meaning customers are actually paying you to hold their money. This results in a negative cost of funds. And there are no covenants. No one can tell Buffett how to invest the float. He had found the holy grail of capital management, a massive, long-term, cost-free source of funding that he could deploy with complete sovereignty. The acquisition of National Indemnity was the pivotal event that transformed Berkshire Hathaway from a dying textile mill into the diversified investment behemoth it is today. It provided the rocket fuel for decades of acquisitions and investments. The underlying psychological principle that makes float so superior to debt is its relationship with time and gratification. Debt is the embodiment of instant gratification. You want a car, a house, or to expand your business now, so you borrow the money and agree to pay for it later. It pulls future consumption into the present, at a cost. It is a system built for the impatient. Float, on the other hand, is a system built on delayed gratification, but on a grand, institutional scale. The policyholder pays their premium now, delaying their own gratification, in a small way, in exchange for a promise of future protection. The insurance company takes custody of that money now, with an obligation that will only come due in the future. This requires a long-term mindset. It requires the discipline to manage that pool of capital prudently, knowing that it must eventually be available to pay claims. Buffett's genius was to recognize that the structure of the insurance business perfectly matched his own psychological makeup: extreme patience, a long time horizon, and a focus on rational capital allocation. While the rest of the world was chasing quick returns with expensive debt, he was patiently building a system that provided him with a permanent and ever-growing source of free money. It's a fundamental inversion of the typical financial mindset. Instead of paying interest to others, he structured his business so that he was, in effect, being paid to invest other people's money. This is the ultimate financial power move. How can an average person or a non-insurance business apply this powerful mental model of creating their own float? This is a blueprint for flipping the script on cash flow. For a business, the goal is to create what is known as a negative working capital cycle. This means you get paid by your customers before you have to pay your suppliers and employees. Think about a company that sells annual subscriptions. They receive 12 months of cash from the customer on day one, but they only deliver the service and incur the costs of that service month by month over the course of the year. That upfront cash is a form of float. Amazon is a master of this. They often sell a product and receive payment from the customer immediately, but they may not pay their own supplier for that product for 30, 60, or even 90 days. The difference is float that they can use to fund their operations and growth. For an individual, creating float is about a disciplined approach to personal finance that mirrors this principle. It is the concept of paying yourself first taken to its logical conclusion. The moment you receive your paycheck, before you pay your rent, your car payment, or your utility bills, a portion of that money is automatically transferred to your investment account. This becomes your personal float. You are taking custody of your investment premium first and using it to build your own capital base before meeting your other claims, your monthly expenses. This simple psychological shift from investing what's left after spending to spending what's left after investing is the individual equivalent of generating float. It reverses the flow of capital. Instead of being a debtor who pays interest to others, you become a capital allocator who earns returns on your own growing pool of funds. It's a powerful strategy for building wealth and achieving financial stability. The antithesis to the genius of float is the entire ecosystem of the buy now, pay later economy. This is the path of the 99% on an industrial scale. Services like Klarna and Affirm, along with the traditional credit card industry, are built on the exact opposite principle of float. They are systems designed to monetize impatience. They tell the consumer that they don't have to wait, they don't have to save. They can have the new phone, the new clothes, the vacation, right now. All they have to do is agree to make a series of future payments, often with high interest rates attached. This is negative float. The consumer is paying a premium, a cost, to pull future consumption into the present. It is a system designed to systematically transfer wealth from the impatient to the patient. The companies providing these services are, in effect, the beneficiaries of this negative float. They are the ones who are patiently allocating capital and earning high rates of return from those who cannot or will not delay their gratification. Payday lenders are the most predatory example of this model. They provide a small amount of cash now in exchange for a massive claim on a person's future paycheck. It is a debt trap that is incredibly difficult to escape. The entire consumer credit industry is a monument to the financial power of impatience. It stands in stark contrast to Buffett's model. He built his empire by creating a system that harnessed the power of patience and delayed gratification. The modern consumer economy is built by creating systems that exploit the universal human desire for instant gratification. The direct financial connection of float to Berkshire Hathaway's success is staggering and can be seen directly on their balance sheet. As of the end of 2022, Berkshire Hathaway's insurance operations had a total float of over $164 billion. To put that number in perspective, it is larger than the entire market capitalization of companies like Disney or Nike. This is $164 billion of other people's money that Buffett gets to invest for Berkshire's benefit. Now, let's quantify the advantage. If Berkshire had to borrow that same amount of money from a bank, even at a very low interest rate of, say, 4%, the annual interest expense would be over $6.5 billion. That is $6.5 billion in profit that would be transferred from Berkshire's shareholders to the banks every single year. But it gets even better. Over the past 2 decades, Berkshire's insurance operations have been so well managed that they have consistently generated an underwriting profit. This means that the combined premiums they've collected have been greater than the claims and expenses they've paid out. In effect, their cost of holding that $164 billion in float has been less than zero. They are being paid to hold and invest this massive sum of money. This is the secret engine of Berkshire Hathaway. It is a permanent, ever-growing, negative-cost source of leverage that has allowed Buffett to make the massive investments in companies like Coca-Cola, Apple, and American Express that have generated hundreds of billions of dollars in wealth for his shareholders. It is the master's alternative to the fool's game of traditional debt. It is the ultimate testament to a financial mind that doesn't just play the game better than others. He has designed a better game entirely. You have just been handed the master key to financial survival. You have absorbed the foundational principle of Warren Buffett's entire empire. The absolute rejection of indiscriminate leverage. This isn't just one tip among many. It is the bedrock upon which all sustainable wealth is built. It's the knowledge that before you can dream of winning, you must first build a fortress that makes it impossible for you to lose. You now understand that the game of money is not about maximizing returns. It is about staying in the game long enough for the power of compounding to work its magic. You have acquired the mental shield. But understanding why you shouldn't die is only the first step. This principle of the fortress balance sheet, this aversion to the lethal asymmetry of debt, is one pillar in a cathedral of interconnected mental models. It is the shield that protects you from ruin. But how did Buffett forge the spear? How does he decide what to buy with all the crisis capital that his shield allows him to accumulate? How does he identify those wonderful businesses at fair prices? Knowing how to survive is essential, but it is not the same as knowing how to thrive. The answer to that question, the method for finding those undervalued companies, is the missing link. It's the next piece of the map that connects the principle of financial protection to the strategy of immense wealth creation. It's the bridge from risk management to opportunity identification. And that very map, that next critical insight that unlocks the offensive side of Buffett's brain, might just be in the video YouTube is recommending to you on the screen right now. This journey of mastery isn't for everyone. It's for the builders, the capital allocators, the determined few who choose to operate on a different level. It's for those who understand that building true, lasting wealth is an intellectual pursuit, not a game of chance. The choice you face now is not simply whether to watch another video. The choice is whether you are content with just the shield, or if you are ready to complete your arsenal. The choice is whether to continue your ascent from survivor to victor. The next step is on the screen. Click it, and let's forge the spear.